All right. Hello, and thank you for joining us. I'm Andy Arnold, CEO and Senior Wealth Advisor here at Centerline Wealth Advisors. This is the next episode in our series we like to call Between the Lines. We make it easy and we hope fun for you to learn about a wide range of topics. We look between the lines and dig deep on many subjects so you don't have to spend your valuable time making sense of new developments. Today's session is all about IPOs and the indexing trend that has stock concentrations at historic proportions. Investors' appetite for risk seems to be off the charts and gives us pause as we don't really like extremes in either direction in markets, which is a big part of the reason we named the firm Centerline. The families we serve want to try to protect what they've built just as much, or maybe even more than simply to grow it from here. Some quick housekeeping first. Please put any questions or comments in the Q&A section, and we'll be sure to get to those. Please don't take anything we discuss as personalized investment advice. Investments should only be made in the context of a complete, well-crafted financial plan. Anything less is just gambling, in our opinion. We'll follow up and send you a link of the recording in a few days in case you miss anything. Wealth managers and CFPs Jeff Wood and Jack Wilson from our team are here to help with our panel discussion today. And we invite a couple of friends and analysts, Jasmine Fan and Seth Morris, to join us on this exciting topic. So let's start with the IPO market, or initial public offerings. I have some thoughts, but Jasmine, if you could very briefly take us through it. What is an IPO anyway? We're all hearing about it, reading it in the news. There are some high profile things going away. So let's talk about that and start there.
Of course. Thank you so much for having me in the first place. And obviously, 2026 has been a big year for IPO markets. I am going to share my screen just now to really show you how different 2026 has been compared to 2025 or the previous couple of years where you have seen some of those IPO phenomena, but not so much as 2026. First of all, what is an IPO? IPO is when a private market decides to take itself to the public market, where people can actually actively trade their stocks. And you can think of it as a way to actually finance use public markets, meaning a lot of other people can actually participate in the gains or the fall of their business activities. Just looking at the left side of the screen, you can see the overall or the average deal size of 2026 had been so much larger compared to the average in the previous 10 years. And even just looking at the total number of deals, 2026 has seen a huge pickup as well. And that's really because this round of AI boom or, the excitement around AI technology advancement has been really driving this higher expectations for market returns, especially in the technology sectors and in the tech space or the startup space. So you probably have heard about SpaceX IPO just 2 months ago, and we're looking forward to a couple more big names like Anthropic and OpenAI. And it's important to know those are the first time we actually see startups or companies going into IPO at above $1 trillion valuation. Just think about Meta or Google, some of the well-known names that you might have heard of in the past. They actually went to IPO at around $10 billion, and that was a big number back then. And now you just have such a giant size of IPO, which is unheard of. And the first time we're seeing this in 2026.
Wow. So those companies started at a 10 billion valuation and it took them years to get to 1 trillion. And you're saying some of these companies coming to market now are starting at 1 trillion.
Exactly, which is just amazing to know.
Okay. So that gives us a little bit of the context. Private companies that are looking to raise capital, one of the ways they do that is to issue stock to shareholders so that as investors we can buy those, or we can buy them through mutual funds and other ways to access the to access a portion of the capital there. So, um, I know we talk about risk and reward. I think a lot of people look at IPOs as maybe a quick and easy way to make money, and some IPOs have been very successful. Maybe not at the initial launch. There's been some volatility. We've seen that with SpaceX. It kind of went public. First day or two, it kind of shot up, and then it started to slide back down. Part of that is for factors that people maybe don't appreciate, that some of that stock starts to unlock. Employees that have worked there for years would like all of their wealth is now concentrated in the company they work for. So they have to worry about getting fired if the company doesn't perform. All the wealth they've created and all the hard work they've done locked into that one entity. And so the IPO gives them an avenue to start selling their shares into the open market, which is great for them. But for us mere mortals that invest in IPOs, that can create some challenges. And I actually have some experience with this early in my career. I had a client who was very interested in a very small company that was going public. He was an engineer. This was a team of engineers that had a process. It all looked great. He got into shares of the IPO, which priced at $25. The first day it went up into the 30s. He felt like he was doing great. And the next thing we knew, a couple weeks later, that stock traded overnight down to near zero. And it's because it was revealed that they had fraudulently um, uh, disclosed books and some in their books and some of their records. Fraud was detected, and so that company wasn't what they thought. So that investor lost. It wasn't a lot of money, but relative to his net worth. But what he thought was very promising turned out to vanish literally overnight for him. So those are some of the challenges that we see, and we are often afraid when someone decides that they want to really swing for the fences with something like an IPO. I don't know if we're having some technical difficulties there, Jasmine. Are you still on the line? Okay, so she's working to dial back in here. So in the meantime, maybe we could talk just a little bit more and see if we could round that out. I know we were looking at the graphic of the amount there that's that's really um, quite different this year than in previous years. Jasmine, are you back with us? All right, Jeff, Jack, do you? Oh, here we are. Okay, we were just talking about some personal experiences with IPOs over the year and some of the risks inherent in it. So let's see. So we could pivot here a little bit to, I could pull some slides up. We could pivot to this a little bit here. Let's see. Are you able to see the shift in value creation there?
Yeah, we got you.
Okay. So I think this is one of the things that we need to understand is that companies are staying private longer, so they're taking longer to actually IPO in the markets. In 2014, it was about 7 years that companies were private and growing before they decided to IPO. And now in 2025, the most recent year we have this, it's taking 11 years. So that value creation is happening before many investors can access it. And so I think that's another takeaway from all of this is that part of the reason you're seeing these $1 trillion IPOs is because these companies have just stayed private and grown their value before they access the public markets. And what I
Yeah,
call mere mortals, the rest of us are able to invest in them.
Yeah, and if I could jump in there, Andy, just give like a little context around that. For a long time, people liked investing in small and mid cap companies. It was a good way for investors to get exposure to some of these companies that might turn into the Metas, the Nvidia of the world. But an interesting phenomenon that's happened here in the last 10 plus years is companies have the ability to stay private longer because there's these large companies. If you've ever heard of like KKR and Blackstone, these private equity firms that are more than happy to fund an OpenAI, a SpaceX, an Anthropic. And if you think about it, if you put yourself in the company's shoes, if you're the CEO of that company, would you rather stay private and not have to report to the SEC, not have to do quarterly earnings, not have to do all of this paperwork, hire different people to be able to deal with the SEC? Or would you rather stay private and not have to worry about that? And that has created a shift in markets where you've seen this almost double how long companies stay private. And the interesting thing is they're missing that small to mid to large cap run. And like we just saw with SpaceX, they're IPOing as a $1 trillion company. And they will sit when they go into the indexes right inside of a large cap bucket. So it's been extremely interesting. And I think, for firms that I work for, as well as retail investors that you work for, it makes it very difficult on A, how do we get exposure to that? But B, when does it hit these indexes going forward?
Yeah, and we're going to talk about index investing here in just a couple of minutes and what's going on that side. Jeff, Jack, do you have some thoughts, additional thoughts on IPOs and what we're seeing?
Yeah, I think, there's a lot of misconceptions out there in terms of the so-called getting in early to an IPO, but kind of what Seth was talking about, and historically these have been small to mid-cap companies that have then IPO'd. This has not been the new called mega cap company, a company worth, a $1.8 trillion valuation that is initially having to IPO there. So it's just a different backdrop and how historically how IPOs have performed in the past.
Yeah, and I mean, adding to that a little bit, I mean, it did give some of those initial investors a chance to capitalize on those returns that maybe a lot of us as retail investors weren't able to get in. So, looking for alternative strategies is key here. And on the other side of that too, as far as the performance goes, what we've seen in the past is kind of alluded to earlier, there was a big pop initially, and these do tend to not really overperformed the S&P on average for the first couple of years, at least. So looking at this as more of a long-term perspective than, a short-term try and flip it and make some money is probably a more healthy outlook.
Yeah, and two, I think somebody that's interested in IPOs in general might be better served educating themselves and learning how the private markets work. And of course, there are pros and cons to that as well as with any strategy. But it's possible to get exposure to these companies earlier in their life cycle if you're willing to give up on liquidity and some other things and have a very uh, long-term focus rather than try to jump on in the IPO market and feel like you're missing out if you don't get in on the day one, but then also maybe regret it later if the promise of the IPO doesn't pan out.
You bring up a good point, Andy, about, if you're really interested in these, you know, start looking at private markets. There was a stat that I saw. The average return of these companies is around 24% pre-IPO, and the average return from open the first trade for that annualized year is -1%. So again, a lot of that alpha or a lot of that growth comes before the IPO, which I think provides that context of, hey, if I really like some of these companies, maybe I need to talk to my advisors about what does it look like and what are the risks involved with investing in private equity or private debt for that matter.
Yeah, for sure. Okay, so why don't we, while we wait for Jasmine to rejoin us here, why don't we pivot a little bit towards index investing? This is something our team has been watching, and I think concern growing because what we're seeing is some of the headline indexes which grab attention, the numbers that they're posting. We hear some investors say, "Oh, well, investing is easy because all I have to do is buy an index." And in my career, which I would admit how many decades it is now, what I've discovered is that when investors pile up and herd into one particular asset class, it often doesn't end well. And the examples I can give early in my career, in the late 90s, investors were piling into technology stocks, and it seemed like there could be no end in sight. The returns were fantastic. In fact, some mutual funds, tech-focused funds in 1999 returned north of 90% in 1 year. And I remember investors saying, well, that's what I want. Of course, in March of 2000, we started a tech correction that took the S&P down 50%, 49.1%. It took the NASDAQ down 75%. By the way, if you lose 50%, you need 100% to get back to even. If you lose 75%, you need 300% to get back to even. There have not been periods where the markets have risen 300% in a year or two or three or maybe even four or five to get you back to even. So that concentration in tech did not work out. What did investors do? They then pivoted to safer investments like utilities and energy in 2002. Well, guess what happened next? A little, well, large company called Enron imploded and took energy and utility stocks down the drain with them and taught investors another lesson because they heard it up there. Well, where did they go next? Oh, obviously, real estate is a safe investment. Let me put my money in real estate stocks and private real estate and all of that. Well, then along came something called the Great Recession. And in October of 2007, that bubble burst, and investors were once again um, challenged by a rapidly declining real estate market that took more than real estate down with at that time in such a large correction. So our concern is always that investors piling into an index, which is now overly concentrated in tech and AI names, those companies are now using a lot of leverage to build out infrastructure. And so even if there's not a bubble burst, there could be disappointment in that as we see reversions back to the mean. So, Jasmine, you're back with us now. I know you missed a
Yeah,
little bit
sorry,
of time.
Andy.
That's okay.
Yeah, sorry for disappearing, just on the IPO topic. But just
Well, you're back now and you're at the beach, so you obviously
I
have
know I
better
had
internet
some
connection
improvement.
on the
Yes.
shoreline there. Yeah. So yeah, please continue. So we I think we covered IPOs pretty well here, unless we have other questions that come in the Q&A, and everyone feel
Yeah.
free to raise
Yeah.
questions in the Q&A.
Yeah, I just want to comment on, what you were talking about, the tech concentration, especially at the index level. What we have realized is that, in the last 5 years, we talk about mag cap concentration, mag 7 concentration. That's no longer true given the underperformance of hyperscalers this year. And what we're seeing this year is really the AI concentration because everything is AI now. Your semiconductor is AI, your utility company, your power station infrastructure is all AI. So we have some analysis to show that your SP 500 index is actually now 50% of AI versus just a year ago, that was probably 35, 36%. And also on top of that, you have more AI exposure in your credit market exposure, given now 23% of credit issuance is offered by AI or AI related items. So your overall portfolio concentration is much, much larger. And it really demands for additional caring or just additional consideration of diversification or trying to be not intentionally being even more overweighting in AI.
Yeah, that's a great point. And I think a lot of people, and we'll kind of shift to the indexes here in terms of A lot of people have concerns of, in the past, index funds have been a good way to have built-in diversification in terms of giving you a broad representation of the overall stock market. Now that there are some concerns about the concentration currently in the like in the S&P, for example, but now some of these IPOs who potentially could get added to the indices. And I know there's, all the different indices have different inclusion rules, and typically there's reporting requirements, and you have to prove profitability and financials and things of that nature. But now, potentially, there's changes being made to that. So there are some concerns. So maybe it's a good idea. We could kind of talk a little bit about what those inclusions look like on the index side.
Yeah, I think that's a super important topic because it was the most well-known misconception that I have heard around IPO when SpaceX was going to be included. And again, remember, this was a company valued at 1.5, 1.6 at the time of IPO. A lot of clients or just everyone on social media was very concerned about the index inclusion because they would assume that 1.5 trillion would go into index and force people to buy SpaceX if you own a lot of the indices or ETFs that are tracking those indices. And the truth is that is not or that's not what actually happened for two reasons. One, most indices or most ETFs that track indices follow a free float market cap methodology, which means only the part of the market cap that is openly traded in the market, meaning the shares that are not with the current employees, not owned by founders, the ones that are actually open to the markets can be counted towards that index methodology. That is actually a very small percentage for SpaceX. That is only 3% of that $1.5 trillion valuation. And for different startups or for different companies, that free float number is different at IPO. For Anthropic, it is currently estimated to be around 7%. For OpenAI, that is 9%. But again, that's all single digit numbers at IPO. And with more shares unlocked along the way, more people, early employees at those companies get their financial freedom with that unlocking of their shares, that free float number will increase. But at the beginning, it's such a small number, which means when we see SpaceX in a lot of the common indices, it's such a small percentage. It is roughly 10 bips of Russell 1000, and that is 0.08%. So very, very tiny of a share. And the other thing is that a lot of indices have different inclusion timeline. For example, SP 500 has a waiting period of a year, 12 months. And also it has a profitability filter, which means that unless SpaceX has positive cash flows or, showing positive profitability, it's not going to be included in SP 500. That's why you don't see it in a lot of the common indices. So first of all, it is a very small share of common equity market indices. Two, it is not in all indices, at least not in the first year. And as we pointed out, you actually see most of the volatility associated with IPOs in that 12 months following that initial offering. It is actually very helpful for investors to not get exposure to those companies in an index format in that first 12 months.
Yeah, no, that's great stuff there. One of the things that we're coming up against is, we've had a pretty strong raging bull market, and in that case, with the 100% upside participation, obviously for the investor that feels like pure euphoria. However, they can also deliver that same participation during market pullbacks and severe corrections. So for those of us that are living off portfolio distributions, or approaching a large liquidity event like buying a new home or retirement if you need for that. Why is mitigating a severe drawdown more critical than squeezing out the last bit of performance in a late stage rally?
Yeah, we actually have a lot of analysis around this. It is so important to manage risk in a portfolio, especially in this round of AI boom or this round of crazy AI rally. And I would just use July as an example, right? People who had that AI concentration or semiconductor concentration had clearly benefited from that in the first 6 to 7 months of the year. However, what we have seen is a significant amount of concentration and also a huge amount of leverages in the system. Globally, we are looking at $300 billion in leveraged ETFs, and that's mostly in technology and semiconductor names. And if you have heard about the leverages in South Korean market, they run at 7 times of regular index levels, especially for the semiconductor companies. The two, the HK Hynix and Samsung that drove a lot of that amazing return. And the amount of leverage and rally was what caused the drawdown that we saw in July. And not only the drawdown, the volatility we saw in July was huge. About 1/3 of the trading days in June and July, we saw semiconductor index experiencing more than 5% of volatility, meaning down 5% or up 5%, right? That was just not seen in the previous 10 years. In the previous 10 years, only 3% of trading days we have seen that level of extreme volatility. So not only that, the concentration and leverage led to a huge amount of volatility, it really contributed to fast drawdown when it happened in July. So as we think about AI concentration, again, we don't think that investors should give up their AI exposures because, again, we still view AI as a longer term trend, a secular theme that will benefit, not obviously from a technology perspective, but also productivity growth around the world in the next 5 years. So we do want to have exposures to it, just not the concentration and not the volatility that we have experienced. And there is really a lot of ways for us to manage that volatility when still getting exposure, still getting that upside participation. And we have a lot of data points to show that, when you experience this level of amazing rally, it actually benefits everyone to stay invested, but managing that risk and not go all in that last. And again, I'm not calling this the last round of the AI rally, but not towards sort of the later part of this equity bull market.
Yeah, well, that's great. And I mean, kind of furthering the topic on risk mitigation and all that. I mean, the last 15 years, passive large cap growth has been dominant, but that's also coincided with, a period of near zero interest rates. We're seeing kind of that shift, as you alluded to. The backdrop is now more of a higher cost of capital. Of course, we have deglobalization. We have domestically, at least, sticky inflation. So why might you consider intentional factor tilts to outperform the passive market? So how does that look when we're positioning those?
Yeah, a couple of things. What had worked really well in the last 2 years from a factor exposure perspective was actually momentum and value. And that's because when we see the success of agentic AI, most of the AI capex was going into the value names or the value styles in equity markets. Just think about the manufacturing of semiconductor, the manufacturing of AI infrastructure, building more data center and power station. That's all value or, value style, value factor. And also, as we mentioned, because it was so concentrated, everyone was really piling into the same exact trade. We have seen one of the strongest momentum factor performance in years. And obviously, what happened in July was that momentum unwind. So in a way, the market didn't care about quality as a factor. However, in the next 2 years, I do think the market environment would bring quality back into focus. As you mentioned, what we're looking at is higher financing cost. We just saw that the longer end of the yield curve, the 30-year US Treasury yield is up at the highest levels in decades. So there's a lot of competition in that AI financing space. At the same time, we're seeing increasing geopolitical volatility driven by Iran, driven by US-China tensions. And that complicated macro environment is going to trigger more focus on quality. And when I say quality, what we're paying attention to is really cash flow, making sure that there's healthy cash flow, making sure there's lower leverage, and also making sure there is efficient operation, operation metrics. And those numbers were not being rewarded in the past year because people were rewarding higher leverages or higher AI-led growth. But now I think we're approaching an inflection point where people will have to pay more attention to those cash flow metrics. And the other reason we're seeing more attention to cash flows is because hyperscalers or the mega cap companies do not have cash flows anymore. Think about Apple, Meta, Google. They were known for how much cash they have, or they're sitting at huge piles of cash in the past, and now they have put all of that into AI investing. So they do not have cash for people who hold technology in portfolios. So people have to turn into dividend or other high cash flow names to get that higher profitability metrics in their portfolios. And what we have seen is that high dividend has been a great hedge to AI. Whenever you have seen a drawdown in AI names, look at the day performance of dividend, they're up. So that has been a great AI diversifier in our opinion.
Yeah, we believe the same thing that that those diversifiers can help protect the downside to some extent, give us more diversification while still participating in the AI trade. We do have a question here that it's basically saying, I work for the government, have access to a thrift savings plan through the government, but they only offer 5 index funds. Should I be worried?
I would say the answer really depends on what 5 index products do they
Well,
have.
one of them is the S&P, one of them is the S&P 500. So, yeah, so if that's the only avenue to get large cap domestic exposure, with 4 other options, is that, potentially something to take a deeper dive and really understand the risk and how to allocate across that. Unfortunately for some people, that may be their whole retirement. They may have been a government worker their whole careers, and they don't really, unless they retire and roll it to an IRA where they have thousands of choices, they may be kind of stuck. Although we have some ideas on that as well, but potentially stuck with just those 5 choices. So I don't know. Let's hear from the panel a little bit. Any thoughts on that?
Yeah, I would say I'm pretty biased in that I do think a diversified index has worked really well. So there's not a huge problem of owning SP 500. But I think where the problem is are in 2 places. One, let's say at the stage of your retirement, you actually do not want to experience a drawdown of 20%, 30%, which happens in SP 500 every couple of years. Then you do want to have other forms or other format of investment that can balance that volatility a little bit. So you don't have to experience that stress, in the part of your life where you should be enjoying, that financial success and, enjoying life. And the other aspect of problem or concern is really how do you balance that 5 funds in that portfolio? Usually there's really lack of guidance in a lot of those pension plans or in a lot of those 401k plan in terms of how you size your SP 500 versus some of the fixed income exposures. And I think that's when, and an advisor like you guys can really step in and help out from a portfolio construction perspective, and also offering more alternative exposures to balance that potential volatility we see in equity markets.
Yeah, and to add to that, I think it's really important. What you said is, working with an advisor and being diligent, even just on something simple like a rebalance. When you have a lot of allocation to an S&P index, something like that, that can start to really run away with that type of growth, especially in this bull market where we're at now. And you run the risk of being much more over concentrated in just the large cap and mega cap, but especially in AI, if that runs away without paying attention to rebalancing. So something that is running away a lot more quickly than maybe in the past it had done. So it's a bigger consideration moving forward, I believe.
And I guess, to kind of wrap all this up and kind of take a step back, we talked a lot about AI. A lot of clients and families are hearing AI this, AI that's the talk of the talk. We talked a lot about IPOs, indexes. Maybe talk a little bit about kind of just from the macro, how a lot of people may say this sounds similar to the internet boom and the dot-com bubble per se. Could we talk a little bit about kind of how today's market backdrop compares to that?
Yeah, this is a very common question we have been seeing, especially in November last year, when people were all of a sudden very concerned with AI, or the word AI bubble started to appear, everywhere when I go on social media. I would say there are two places where this AI cycle, or this AI boom is quite different from the internet bubble or the previous, recessions. One is that we're seeing real productivity growth coming from AI. Again, I think everyone here probably have used AI in their day-to-day, right? Summarizing notes, generating content, generating graphs, and even in personal life, I use AI a lot to plan my trips, to get something done really quickly. I don't have to, use a lot of the more sophisticated software tools. My best example is that, I think in a year or two, I'm not going to pay for TurboTax or a tax consultant. I'm going to file my own tax. I'm going to, save a lot of money by using AI. So there is real productivity growth. And at the business level, this is even more true when we think about the dot-com bubble, right? A lot of companies were there trying to figure out a business, trying to leverage the internet, but they don't have a business. Whereas today, when we look at the largest 10 technology companies in the US, they already have a robust business model. And AI is actually accelerating their revenue growth after improving their advertisement result, improving the artificial selection, the recommendation system when we use Meta's products, when we use Google's products. So AI has been hugely additive to their current business models, not even to mention the cloud business. So the growth rate is quite different. The other thing that's hugely different today versus 26 years ago is valuation. When we were sitting at the peak of dot-com bubble, we were looking at a tech valuation of 55 or 60 to certain companies. Today, technology, or when we look at NASDAQ, it's only around 30. And with the recent drawdown, it's actually lower than 30, which is not at a stretched level at all. And even when we look at a company like NVIDIA that is growing revenue at an amazing rate, its P ratio is also below 30. And we usually use this comparison that NVIDIA's valuation today is actually lower than McDonald's valuation. So if you are comparing a fast-growing company that's valued at the same level as a fast food trend, you must know that this technology rally has a pretty fair valuation, or even I would argue is at a pretty discounted valuation. Again, I don't think this means NVIDIA is going to rally a lot to catch up to the fair valuation. I do think this discount is reasonable to reflect that uncertainty in future cash flows. But just comparing that to what was the level during dot-com bubble, I think there should be less concern about AI as a bubble or AI as a potential recession driver. But that said, we just talked about volatility in AI concentrated markets, in AI concentrated indices. I think that's still a real problem, but we don't think AI by itself is the problem or is the bubble.
Yeah, those are all great points. I have a little perspective on it too. Of course, I use some AI tools, but I've also run across many examples where it's just plain wrong. We had a family that was trying to do some long-term care planning for an elderly relative and sent us some kind of breakdowns in a spreadsheet and things created by AI. And Jeff and I found three glaring problems with it almost instantly that completely changed, the person's thinking 180 degrees. And just a couple of weeks ago, I was using a tool just for something personal, and I spent 2 hours trying to solve this problem, plugging some technology together, and I couldn't figure it out. Restarted the computer, all of this, and come to find out the AI got it 100% wrong. It told me to plug the inputs into the out. So it was 100% wrong. And I wasted 2 hours, thinking I was getting a shortcut to help me connect some components. So, they call them hallucinations, but the truth is sometimes it's just plain wrong. So it makes me think that I'm sure the technology is here to stay. I'm sure it will make us more productive, but I do think there's an element of just caution in all of it. So before you fire your CPA, you may want to make sure that either the circumstances are so simple that AI can't get it wrong, or that that you certainly have a human looking over it, because that can getting a love letter from the IRS is never fun. And ChatGPT is not going to contact the IRS for you. Just my 2 cents.
100%. My funny anecdotal evidence is actually in one of the IPO chart that I shared earlier. We actually couldn't get AI to tell us what are the largest IPOs in the last 20 years. It's such a simple data pool, but AI just could not figure it out. And we were all very disappointed.
Interesting. All right, well, we're coming up on time here. Any other open questions or any other comments we'd like to make here before we wrap up?
No, I think we got to them. If anyone else has questions, feel free to send us an email. We can always get back to you at a later date.
Sounds great. Well, Seth, Jasmine, thank you so much for your time. We really appreciate it. Sorry for the tech issues through Zoom here, but who knows? Maybe AI will fix the software while we're asleep tonight. In any regard, thank you all so much. Thank you everyone for joining us. If you have questions, reach out to us and we'll have a recording available here in the next few days. Thanks, everybody.